P N Vasudevan, MD and CEO at Equitas Small Finance Bank, now joins in to talk about their numbers. Mr. Vasudevan, good to have you on ET now. Let's first begin with the operational figures. Your interest expense with the quarter rose about 37%, which has led to this NII growth of around 8%. Your cost of funds slightly inched up. What are your anticipation in terms of interest costs going forward, and should we expect further pressure in this year?
So, last year we started the year with a CD ratio of about 100%, and by end of the year we were able to reduce it to around 87%. And if you see the last quarter, fourth quarter of last year, for example, our CD ratio was at an average of around 90%. The CD ratio for the first quarter of this year is at an average of around 87%. So what's basically happened in the first quarter is that because of the CD ratio coming down, which means basically that we mobilize more deposits and put it into a lower yielding investment book and not into the advances. So that's the reason why you see a spike in the interest cost in the first quarter. But now the first quarter, the CD ratio is at an average of 87, and we are fairly comfortable at this 85 to 87% CD ratio for the rest of the year. So we expect the CD ratio to be kind of steady around this 85, 86% levels for the rest of the year, which means that the interest cost increase should abate a bit. The interest cost increase will be largely only for mobilization of deposits for growth in business and not for the CD ratio bringing down purpose.
Right, Mr. Vasudevan, what we also want to know in terms of slippages, now that has also seen an increase during the quarter. Was it mainly due to MFI segment? Is it a region-specific stress that you're seeing right now? And do you see any early signs of easing off on this front? And if the stress remains, what is your strategy to maintain the asset quality going forward?
So the slippage in the first quarter was around 4.4%, definitely higher than the normal 3.7 to 4% that we normally have. I mean, around a 4% is something which is par for the course for portfolio of our profile. But this first quarter was definitely a little bit more elevated than our normal slippages. The reason is one, of course, Q1 generally is seasonally a weaker quarter in collections compared to Q4 of the previous year. That's always a factor. Second, of course, we know that there was an election, so these two tend to have some level of disturbance at the ground level in terms of collection processes. The third thing is that microfinance has been seeing some level of stress building up over the last, I would say, maybe 2 to 3 quarters in different parts of the country. And so these are the combined reasons why you see a slippage which is higher in the first quarter compared to the fourth quarter of last year. Going forward, I believe that the normal collection efficiencies would kick in all other products from Q2 onwards. So we should see slippages coming back to normal levels in all other businesses. As far as microfinance is concerned, yes, there is a lot of discussion going on at the industry level. There's a code of conduct within the industry in terms of lending practices of all of us, and some amount of seriousness has definitely come into the industry that we got to follow that code of conduct very rigorously if all of us want to have a better quality of book from the microfinance business. So I think there's a hope that there'll be a lot of joint effort by all the lenders to try and bring some level of enhanced discipline and following of the code of conduct in the market. And as that pans out, I'm hoping that microfinance will also start coming back to more normal levels.
Okay, but what about the overall credit costs? Are you, anticipating some change in your guidance there?
So beginning of the year, we had guided that this year the credit cost should be around 1.25%. By and large, we should be able to stick to that, except the fact that this microfinance stress is something that has been building up, and it really came up sharply in the first quarter. So there is only one caveat on that. So I would say that we would just like to wait for the second quarter to come to an end and see how the microfinance slippage and the credit cost is moving up. And basis that, we should be able to guide with a lot more clarity by end of the second quarter.
Right, and when it comes to loan growth, you reported about 17% while you targeted 25%. Let's say if you slow down your MFI book, would you still be able to achieve this figure?
So, see, loan growth starts, of course, with the deposit growth, and our deposit has been doing quite well. So we had a 33% growth in deposit in the first quarter, and our retail term deposit has continued to do very well. Last year also, retail TD had grown sharply, and this year, the first quarter, again, it has registered almost a 50% growth over last year, year on year. So deposits, I don't see as an issue at all, and our CD ratio, as I mentioned earlier, we have brought it to a very comfortable level of around 80, just under 87. So I don't have too much of work to do on the CD ratio front either for the rest of the year. So that leaves us really free in terms of focusing on advances growth. Yes, the first quarter was advances growth was slower at around 17%. But we had guided for a 25% growth for the full year, and I think by and large we should be able to stick to that.
Right, just lastly, we want to know in terms of provisions, right? This time we are seeing that floating provisions that you all have made during this quarter, mainly due to that universal banking. And when you look at your NPAs also, they are right now currently below that 1% mark. So what is your internal target that you have? Because you will have to be maintaining this for a period of 2 years, especially moving towards that universal banking side. So what is it that you're watching out for, and what should we be keeping an eye out on in terms of changes here?
So the RBI had come out with the guidelines on SOBs wanting to convert into universal banks, and we are fairly comfortable with all conditions except this NNPA condition. That is the only one where we are amiss. The guideline says the NNPA should be less than 1%, and we were at about 1.17% in the month of March. So we had to do a one-time correction to bring it down to less than 1%. Our PCR by March 24 was around 56% or so. So we took a decision to do a one-time catch-up on the PCR. We took it to 70%, and the incremental provisions, we created a floating provision and put it into that. So that our PCR also goes to a very healthy 70%, and the NNPA goes to under 1%. With this, we are now fully compliant with all other conditions, and this we have to now maintain it for the next 2 years. And if we do that, then by March 26, if we can continue to maintain the NNPA less than 1%, which I believe we should be able to do, then somewhere in the calendar year 26 is when we should be able to look at applying to RBI for the universal bank.
Okay, thank you so much for that.
If you like this video, then like, share and subscribe to ET Now.